Hello friends, I am Siddharth and today I am going to talk about debt market mutual funds. But before I begin, I have to ask you one small question. Have you ever lent money to someone? You might think, no, I have never lent money to someone, but you have. I'll tell you where you have lent your money. That is a bank fixed deposit. What is essentially happening when you book a bank fixed deposit? You are lending your money to a bank and in return during the holding period you will get something known as interest, isn't it? And when you do such transaction, when you do booking of this kind of bank FD, you get a receipt that is known as a bank FD receipt. And when you make that instrument tradable in the debt market, that is known as a certificate of deposit. Just a way of understanding as to what is debt market. You must have heard about the equity market, but what is debt market? Debt market is one such place wherein all those instruments which involves one lender and one borrower, these instruments are traded into the debt market. So who is the lender? You and me, the investors, and who is the borrower? The bank or the companies, as the case might be. So in this case, this is an example of a bank. This instrument is known as the CD, certificate of deposit. Similarly, whenever government needs money to run the country, so whenever government needs the money for short term like 1 year or a period less than 1 year, government issues some instrument, government sells some instrument to the institutional players, to the big investors in the debt market. That instrument is known as the Treasury bill. And whenever government needs money for the long term, means more than 1 year period, like 10 years, 20 years, 30 years, 7 years, any such duration, then government will again come and sell the instrument, means borrow the money from the big investors into the debt market. Those instruments are known as the government securities. Otherwise, in short form, it is known as the GSEC. It is nothing but a bond, but a government bond. Again, when we talk about the companies, be it the private company like HDFC or a public company like NTPC, they also access the debt market as and when they need money, as and when they want to raise capital. Not from the equity market, but they raise money from the debt market. So what they will do, they will come and talk to the big investors in the debt market. They will sell their bonds to the big investors in the debt market, take the money, give them the interest during the holding period, and on maturity, the investors will get back their money. So these kind of instruments, whenever they are issued by the private companies or public companies, they are coming in two flavors. Whenever these instruments are issued for the short term, like for 1 year or for lower than 1 year period, then these instruments are known as the CP or otherwise commercial paper, which are essentially nothing but the short term borrowing instrument, but traded in the debt market. Okay, and the other part is the NCD. Whenever these companies are going to borrow money for the long term, more than 1 year period, it can be 3 years, it can be 5 years, it can be 10 years. So those instruments are known as the NCD, non-convertible debentures. As the name suggests, these bonds or debentures cannot be converted into equity at the maturity time. So they carry more risk. So therefore, their rate of return is always more than the bank FD. Actually, all these instruments, be it the CP, CD, Treasury bill, government securities and NCDs including, the rate of return is always a bit on the higher side than the bank FDs of the similar tenure. That is the objective of the debt market instruments, to give you more return than the bank FD or to give you more return than the savings bank account. There is some degree of safety, but there is no guarantee as such, let me tell you. The whole objective, the whole idea behind having a debt market is to give you more return than the savings bank account or debt market mutual fund. That depends upon which particular type of fund you have chosen. And by now you would have guessed, obviously, that those mutual funds who are going to invest or trade into such type of instrument in the debt market are known as the debt market mutual funds. Now this brings me to this point, to a particular point wherein I will have to tell you that there are around 16 categories of debt market mutual funds. Yes, you have got it right. There are 16 categories of debt market mutual funds as per SEBI's rules. But basically in this video I am going to tell you only about what is debt fund and how do they operate or where do they invest into. I hope you have understood the concept, you have liked my video. So see you in the next series Until then, bye.